Hi, everyone. This is Jane Joe, broker and owner of Perisson Real Estate, and I'm back with another edition of Perisson Pulse. Today, we have joining us Michael Wong from LTCR Pacific Agency, and he'll be talking to us about long-term care insurance. So those of you who've been following my series, you know that the series for 2024, we're calling it Real Estate and Finance in the Golden Years, and really trying to focus on what are the different issues that we need to be aware of as we grow older and more mature. And one of the topics that has come up for me a lot is long-term care insurance, what it is and whether to get it or not. What are the different considerations? So I was really excited when Michael joined us at our local San Mateo County Association meeting a few weeks ago, and he seemed very well spoken and knowledgeable about this topic. And I'm glad to have him joining us today. Thank you, Michael.
Well, thanks, Jane. Good to be here. I'm Michael Wong. I'm with Long-Term Care Resource Pacific, and what we do is we help families plan for long-term care. So a little bit about me. Grew up in San Francisco. I went to Berkeley for undergraduate, went to University of Pacific for dental school, and I'm a certified long-term care specialist. And our group, what we do is we're affiliated with over 650 national associations. So alumni and professional associations. So if you went to Cal, you went to Stanford, UCLA, if you ever called in to your alumni association for long-term care, they actually would give us that information, and then we would help you out. So we're a national company, and all we do is long-term care. So today's agenda is what is long-term care? A lot of the people don't understand what long-term care is, so I'm going to explain that. Who actually pays for it? Long-term care insurance options, tax deductions. Everyone likes a tax deduction. Then I'm going to talk a little bit about the state mandated long-term care insurance. I'm not sure if your financial planner or your tax person has talked to you about that, but we're going to go over that. And then some frequently answered questions. So these are my parents, so Frank and May. And the reason I have this up there is because this is my wedding in 2001, a couple months after my mom was diagnosed with stage 3 lung cancer. So we took care of my mom for 13 months. And so that's when we got introduced to long-term care. My dad, he was diagnosed with dementia and Parkinson's disease, and he needed care for a number of years. But what I have here is there was two of us in the family. I'm in California, my sister's in Wisconsin. And what typically happens with families is the person that is closest, usually the burden falls on them. And so it fell on us. And so what I hope to do today is to help families understand about the consequences of long-term care and how to protect themselves so they don't have to go through what I did with my family. So let's talk about what long-term care is and what it isn't. So long-term care is not medical care. It's needing help with activities of daily living. So everything we do at home in the morning, you wake up, you take a shower, you get dressed, you eat, use the restroom. Those are things we don't even think about. But when you have, something like a disability, you're paralyzed, you have a stroke, those easy things become very hard. And so that's what people need help with. Definition of long-term care is needing help with at least 2 of 6 activities of daily living, or you have a cognitive impairment. So it doesn't matter how you got there, but if you have any of these, either physical or cognitive disability, then that means you would need long-term care. When we think of long-term care, and growing up, my dad would always say, "Oh, don't put me in a nursing home. Don't put me in a nursing home." And so, that's what everyone thinks about. They think, "Oh, it's a nursing home, and it's really sad." All these misconceptions about nursing homes and what long-term care is. But really, most of the people in the U.S. receive care at home. So here, home health care is really where most people need care. So about 75% of the people in the US receive care at home. So secondly, a lot of times when it gets hard for a family, maybe they need care more than 8 hours a day, maybe they need 24-hour-a-day care, then they'll start thinking about the residential assisted living facility. So when we think of these, we think of the atria, the sunrises. Along with the residential facilities, there's an area called the memory care. The memory care is where they have people that have maybe moderate to severe dementia, or they'll have Alzheimer's. And it's a smaller area. They lock it so people can't wander off. And then there is actually the ratio of caregivers to residents is higher than the general population. And so only about 10% of the people will actually be in these facilities. Next, we get to what we all know is the skilled nursing facilities or nursing homes. So what makes the nursing home different than the residential assisted living facility? It's really the medical staff. The medical staff at the skilled nursing will be on there 24 hours a day, and they're able to do some medical procedures, like if you need a catheter change or you need dialysis, they actually can do that there. And at these places, we own about 15% of the people that need long-term care reside here. And when we think of skilled nursing, we think of Laguda Honda in San Francisco or Brookside here on the peninsula. So let's talk about cost. In the Bay Area, everything's expensive in the Bay Area, right, Gene? So unfortunately, long-term care costs are expensive. It's expensive here. So when we think of home health care, so this is per month. So it's about $8,000, $8,800 per month for home health care. So this is for someone coming into your house 8 hours a day, 5 days a week. So it's not full-time, it's probably more like 1/3 time. So sometimes that gets really expensive. So then people will go to the residential care facility because it's a lot cheaper. They have 24-hour-a-day care. And then lastly, we have the nursing home, which is has the most care, but has the most expense. So if you look down here, you can see that yearly, these are the yearly prices. So it would cost about $106,000 a year for home health care. Assisted living, today's prices is about $92,000. Nursing home would be about $161,000.
Wow. And that's with the memory care, isn't that more? Is that more than the regular residential assisted living or?
Yep, that's correct. The memory care will be about the same price as the nursing home. So it'll be closer to about $13,000 a month. And when we think of inflation, because we all have to deal with inflation, so what happens with inflation? So a rule of thumb is every 10 years, prices will go up 50%. Every
50?
20, 50.
Wow. Okay.
And then every 20 years, prices will double. So in 20 years, prices are double. In 30 years, everything per year, per person, everything will be on, at least $250,000 for one person for a year.
For 1 year. Wow.
For 1 year. Yeah, so costs can get really, really high, and it's hard for people to fathom, especially when they go to like a residential facility and they'll tell them the price, and they're like, "Oh my God, it's so expensive! I never knew it could be this high," and so it makes things hard on families, and for people that are just retired, a lot of times they don't budget for this. So next, who needs care and for how long? So when we think about long-term care planning, there are a couple of factors. One is, are you man or woman? Do you have longevity in your family? Do you have dementia in your family? I mean, so those are the things we'll talk to clients about. And that kind of helps us project out, well, how much potential coverage, how long? And so these are some statistics where if you live to past 65, 7 out of 10 people will need help. And in general, men pass away earlier than women, unfortunately. If you ever go to a long-term care facility, you'll see it's predominantly women, because women tend to live to about 88, men on average 83. If you have dementia or Alzheimer's, you actually need care for a pretty long time. So for dementia patients, they need care about 6 years on average. If they have Alzheimer's, 8 years. you have Parkinson's disease, which is more a physical disease, which my dad had, it's about 11 years of
Wow.
that you're going to need help. So what are the options for long-term care? So basically, private, you could use your own money. You could have your kids or your spouse help you, or you could have insurance. So what's the public option? So the public option, basically, there's only one option. And let me circle this here, Gene, because we get this all the time. Doesn't Medicare pay for long-term care? Medicare is health insurance for people 65 and over. It's health insurance. It does not pay for long-term care. So if you broke your hip, they would pay to have your surgery. They would pay for rehab. They would pay for a physical therapist, but they won't pay for you to be able to use the restroom at home, to get fed, to get changed. That is not paid for by Medicare. And Medi-Cal, so Medi-Cal does pay for long-term care. It pays for long-term care in that you can have some home health care, and it's limited, and it pays for the nursing home. So in California, Medi-Cal, which is Medicaid in other states, pays for 65% of all the nursing home residents in California. So that is a big chunk of California's Medi-Cal budget. So with Medi-Cal, to qualify, you have to be below a certain threshold in income and assets. If you're above that, then you wouldn't be able to qualify there.
So here you say income-based eligibility, but it's also assets. They count your assets in there,
Yes.
including
Yes.
like your primary residence, because you may have a primary residence that has a lot of equity in it, but that doesn't necessarily mean you have the cash to pay for long-term care, right?
What they do is actually now so if it's a husband and wife, just say the husband needs help, the house is actually protected because they're not going to kick out the wife or put a lien on the house because the husband needs care. So it's really more tangible assets, stocks, retirement, those types of things.
Okay.
And so what's going to happen is they're trying to lower the income, not the income threshold, but the asset threshold, which means that they're trying to have more people qualify for Medi-Cal. And I'll talk a little bit about that later and what kind of repercussions that could have. I'd like to bring this up and talk about non-leverage versus leverage money. And usually when people need long-term care, it's kind of like, we always say it's like a fire drill, because the kids come in, maybe mom needs care. Everyone comes in. What are we going to do? And do we have enough money? Should we keep her at home? Keep her, put her in a facility? And so a lot of things come together. But I just want to talk about the money aspect right now. So in this aspect, so just say someone needs care, and it costs $7,000 a month. So usually people will say, well, my largest amount of money is going to be in my retirement. But we all know that retirement money is going to be taxed. So to get that 7,000, you're going to have to actually liquidate 9,100 because of the taxes there. If you have stocks, then you're going to have capital gains tax. So you're going to have to liquidate 8,000 to get 7,000. And if you use cash, of course, you're just spending dollar for dollar. With long-term care insurance, how it works out is you do get a tremendous amount of financial leverage. So it would actually cost you $84 for that 7,000. So your leverage is over 80 times there. So here, I want to break down what actually is long-term care insurance, because some people don't understand, like, what does it do? How does it work? So here, basically, long-term care insurance is three parts. One is you have a bucket of money, and really that's it. You're buying a bucket of money. Two is how much per month can I get out of this bucket of money? So this is called your maximum monthly benefit. Okay, now when we take out in this example, we have 200,000 and we take out 5,000 a month, that would last you 40 months. So that's kind of basically it. You have a bucket of money how much can you get out monthly? How long will it last? Those are the three parameters of long-term care insurance. But you do have options. So remember, you talked about how inflation increases the cost of long-term care. So you have inflation options. And typically, insurance companies, they'll have 2 to 5% compound, which means that every year on the anniversary, this 200,000 will go up, 2%, 3% to 5%. So that kind of keeps up with inflation. And then we look at the elimination period. The elimination period is basically your deductible. So typically it would be a 30 days, 60 days, 90 days. So if someone chose a 90-day elimination period, they pay out of pocket from day 1 through 90. Day 91, your benefits will kick in. So here are the types of long-term care insurance. Basically, it comes down to two types. So one is the traditional and the other is the hybrid. So let's talk about the traditional. So the traditional, you have lots of leverage. It pays for home care or facility care. So it means that you could be at home, a senior care facility, assisted living facility, memory care, or a nursing home. So it basically covers everything there. The other thing that I think a lot of people don't realize about long-term care insurance, which is very valuable, is the care coordinator. Well, what is the care coordinator? So sometimes when you need help and you need to find a caregiver or you need to find a facility, where do you go to? Do you go to Yelp? Do you just ask friends? I mean, there's no place to go. I mean, there's a bunch of paid services. The paid services get a referral fee from the facility. So each company, they actually have a care coordinator. So they will help you find caregivers. They will help you find a facility. So you don't feel alone when you're trying to find something for a loved one. The other thing about long-term care insurance is tax deductible. So we'll talk about that a little bit later. And now let's look at the hybrids. So the hybrids, they're a little bit different than traditional. They have all the benefits of traditional, but it's life insurance and long-term care insurance together. So there's a couple of features of the hybrids that are a little bit different. So one is, as a couple, you apply together. So one policy will cover two people, so partners or husband and wife. You can have unlimited lifetime benefits. So which means that you can never run out of money. Another feature that people tend to like about the hybrids is the premiums are guaranteed. With traditional in the news, people are saying, like with CalPERS, Genworth, premiums have gone up. If you've seen that in the news, premiums have gone up. People are unhappy about that. With the hybrids, the premiums are guaranteed. So the premiums, just like a mortgage, are fixed. So if you can equate the two types of long-term care insurance, the traditional is more like renting, while the hybrid is more like owning your home.
And the premium there's no inflation factor or anything. So once you lock it in, does it stay fixed or does it actually go up as well?
On the traditional, the premiums can go up. On the hybrids, they pretty much are locked.
Oh, they are locked. Okay, so they're not adjusted for inflation along the way. They're locked in. It's like a 30-year fixed mortgage kind of
exactly.
carry that on. Okay, got it.
Yep.
And with the traditional, you cannot cover two people. Each person needs to apply for their own.
That's correct.
Okay, got it.
So I just want to give you an example of a traditional long-term care policy. So in this instance, Tammy purchased a policy when back in 2004. Okay, so remember to talk about the bucket. So this is her bucket. So it was 216,000, and so her maximum monthly benefit was 6,000. So that 6,000 would last 36 months. So she chose the option. She chose to increase her bucket of money 3% a year, and she chose the 90-day elimination period. Okay. So next we go to here. where now she has Parkinson's disease. So what happens here? So her bucket of money grew from 260,000 to 390,000. And now her monthly benefit has gone up. So now her maximum monthly went from 6,000 to 10,830. So if she drew $10,830 a month, her benefits would last 36 months. While she is collecting benefits, the inflation is still working. So this amount, the 390, is actually still growing, even though she's collecting money from the insurance company. And because she has the 90-day elimination period, she has to pay out of pocket from day 1 through 90. And the other thing is that when you're on claim, right here, they waive the premiums. So when you're receiving benefits, you typically don't have to pay the premiums anymore. So let's talk about the hybrids. So the hybrids, remember I said there are two buckets. So it's life insurance and long-term care insurance. So there's three scenarios. So let's look at the first scenario. So the first scenario is just say the husband needs long-term care. So remember he starts drawing on this life insurance bucket. Okay, at some point, he might use up all the benefits of the life insurance. So what happens? Then you go to this long-term care bucket. And this long-term care bucket, I have this infinity symbol because the bucket, there is no cap on it. So whether it costs 1 million, 2 million, 3 million, they'll continue to pay their clients there. So there's no cap on it. Okay, let's look at the second situation. Okay, well, what happens if they never need care? So remember, there's two people on the insurance. So it's a second to pass life insurance. So when both husband, wife, both partners are gone, it becomes life insurance, and the money will go to the heirs or the kids. In the third scenario, just say, they had it for a number of years. They say, we really don't need this anymore. We're okay. Can we have our money back? Yes. So you can actually get your money back based on the percentage.
So with this slide, if I can ask a couple of questions. One is, so scenario A, you have, say, the husband needs care and you start drawing on that. What happens if, like, say, 5-10 years later, now the wife needs care? The bucket doesn't change, right? Or the amount that they get each month doesn't change, right?
No,
okay.
That's correct. So basically, this bucket will sustain them both. Okay. So no matter if this bucket is gone, this bucket will carry on. No matter if he needs care, then just say he passes away, she needs care 15 years later, this bucket will still continue.
Right. But what I'm saying is that it doesn't matter whether it's one person or two people who need care at the same time, the benefit they're getting is going to be the same.
Oh, yes.
Right?
Yes.
Okay. Yeah.
Yeah.
Okay. And then in terms of the life insurance aspect of it, is it the premium that they get, or is it actually the benefit, the amount of the benefit that gets passed on?
Basically, just say someone over the lifetime they pay off. They just say they put in 100,000. The life insurance benefit will be more, so maybe it'll be like $150,000 benefit.
Okay, so it'll be the benefit. It's not just that the premiums get returned to them. It's actually like insurance, so they'll get the benefit amount. Okay, got it.
Okay, so in this slide, I just show how the hybrid works. So kind of like what you're talking about, Jean. So in this instance, so Sam here, so he needs care at $6,000 a month. Okay, so in 2024, he starts drawing. Remember, on the life insurance bucket. Okay, so there's 200,000 in that life insurance bucket. Okay, and so over that time, at 33 months, then this bucket will be gone. So it'll take 33 months here. So in 2027, there'll be no more life insurance. But what happens? What happens is now we go to the long-term care bucket. So that will continue to pay for Sam's care. So just like you're giving that example. So Shannon now, in 2028, she needs care. Well, what happens? she will get the same benefit as Sam has been getting all this time. And they both go together. So for instance, just say they both got 6,000, they would both be, the family would be paid 12,000 a month until they either don't need care or they pass away.
So that's it for the first half of our session on long-term care insurance. Who knew insurance could be so interesting, right? Anyway, I thought it would be better to divide this session into two videos, so please be sure to watch the second one next week as Michael continues to discuss how long-term care insurance works. Specifically, he'll be covering what the state of Washington is already doing in terms of mandated long-term care insurance and what is already in the works here in California. Even if you haven't considered getting long-term care insurance before, there's a good reason to think about looking into it sooner than later. So make sure to watch that video next week, or if you're watching at a later date, it should be available already. And as always, thanks so much for watching our videos. I hope you're finding them to be full of good information for you, or at the very least that you're coming away with one or two new things that you might not have known. Please be sure to subscribe and share with your friends and colleagues, and continue to check back for future videos. Wishing you many amazing days and years ahead.